Hello friends, welcome to EduTap. Friends, if you can hear me, if the audio is clear and the video is clear, please give me a thumbs up in the comment section. This is lecture number 3, Economics and Social Issues. I am going to discuss certain important MCQs that will be very helpful for you in the upcoming NABARD Grade A 2021 examination. Right? If you have not seen the previous 2 lectures, please do see the previous 2 lectures. In fact, we have also conducted a good number of approximately 39 lectures on similar topic of economic and social issues earlier as well. So if you have not seen those lectures, I request you to see those lectures and benefit from the same. EduTap has been working very hard for your success. Please make good use of everything that has been provided to you. I request all of you to please be kind enough to give me a thumbs up so that we can take the discussion ahead. Everything looks good, so let us begin. Friends, join EduTap's YouTube channel. Right, we are coming out with a lot of free content for your preparation, a lot of high quality content for your preparation, which you should benefit from. And all the lectures that we are delivering via our YouTube channel, notes pertaining to the same are available through EduTap's Telegram channel. So you should join 2 channels if you have not already subscribed to them. If you have not already joined them, you should join the EduTap's YouTube channel and the Telegram channel to be able to take your direction, to be able to take your preparation in the right direction. Right, this is EduTap's Hall of Fame. Consistently through many years, we have been able to produce a good number of successful results for RBI Grade B, NABARD Grade A, SEBI Grade A examination. It is a very trusted platform for many students, right? So if you are preparing for these examinations or any of these examinations, be it RBI Grade B or NABARD Grade A or NABARD Grade B or SEBI Grade A or EPFO, you must visit our website and enroll into our courses if you want to take your preparation ahead in the right direction. If you wish to speak to any of us, you can always mail us on hello@edutap.co.in. If you want to call us, the number is 8146207241. Keep these things in mind. Now, I had asked certain homework questions and had urged students to answer those homework questions, and some students have heeded to my call. Nilesh Suryavanshi, Sanjay Sahu, Siddhant Upadhyay, as well as Study Hard, Bikreen Barua, as well as Neil, as well as Shweta Sharma, as well as Saurabh Shekhar. You all have been kind enough to answer homework questions of the previous session. Those who have not answered must go to those videos and answer the homework questions by commenting. Those questions will help you in the examination, and I am going to ask you at least 5 homework questions at the end of this session today. Those questions are very important and you must answer those questions. I was reading the governor's statement which was released recently, right, in the first week of June, and in that statement I came across a beautiful quote, and I have gotten this quote for you. Probably you can use this in descriptive English, probably, right? The greater the difficulty, the more glory in surmounting it. That was the quote that was available in the governor's statement, right? And I'm giving you a big hint. Today's session is based upon the decisions that have been taken by the Monetary Policy Committee in the first week of June. So this is the context in which I have framed the question. Monetary Policy Committee met on 2nd, 3rd and 4th June 2021 and took stock of evolving macroeconomic and financial conditions as well as the impact of the second wave of the pandemic. Right? In the context of the above, answer the following questions. So you see in our examinations, they give you a paragraph, they give you a context, and from that context, from that paragraph, or based on that paragraph, or based on the subject matter of that paragraph, they ask you a cluster of questions. That is precisely what we are trying to do over here. I am going to try and ask you a cluster of questions based on the governor's statement that is available on the Reserve Bank of India's website. Right? So the first question is here in front of you. You know that we are running the government securities acquisition program. Now the second version of that program is going to be launched. This is what the governor has informed us through his statement. Question is very straightforward, very simple. Question is that RBI has decided to undertake GSAP 2.0 in the second quarter of this financial year, and we are going to conduct secondary market purchase operations of so much amount of money to support the market. So RBI is going to purchase government securities worth dash to support the market. How much government security is going to be, or what is the value of the government security that is going to be purchased by the RBI under the GSAP 2.0 program, which is going to be launched in the second quarter of this financial year? You have to give me the number. Our examination is such that they ask you number based questions. So they don't just ask you any random number, they ask you numbers which are significant, which are important. So if the Reserve Bank of India is undertaking this kind of a massive program to be able to stimulate the economy, to be able to help the government in managing its debt, that is a very important number. You should know that number. What is that number? I'm expecting the right answers, and of course you all have given me the right answers, right? The right answer over here is B, 1.20 lakh crore, right? So your answers are correct. Nilesh, Anubhav, as well as Wandering, as well as Debajit Pal, Pooja, Shobhit Goyal. Your answers are correct. The number over here is 1.20 lakh crores. So those who are new to the preparation, it is an important takeaway that these kind of numbers that you are coming across, you must note them down in a small notebook, right? You should describe. So 1.20 lakh is GSAP 2.0, right? And then similarly such numbers, you should note them down. Moving ahead to a slightly more difficult and a challenging question. Reserve Bank of India's decision to step up purchase of government securities under the GSAP can lead to which of the following outcomes, right? What can be the outcome of the GSAP program? 4 statements have been given and you have to choose your answer from those statements. It can reduce the spread between repo rate and 10-year government bond yield. It can result into a greater inflow into the equity market. It can help reducing the borrowing costs for the government. It can keep interest rates steady that can help to kickstart investments. 4 possible outcomes have been presented in front of you and you have to determine that which of these outcomes is possible, which of these can be an outcome of the GSAP program being run by the Reserve Bank of India. Please think carefully and you will come across certain tough questions in the examination. Everything will not be easy and moderate. So how should you navigate those questions? So let us say that you are attempting 65 questions of economics and social issues, let us say. Okay. So your duty should be to first hunt out the easy questions, then hunt out the moderate questions, and then see how many number of questions you have attempted. Take a stock of the situation. And then based on that, you will be able to determine that, okay, these tough questions are remaining. I have some idea about these tough questions. I will attempt these and I do not have absolutely any idea about these tough questions. So I'm going to leave those tough questions. So that is the kind of approach that you should have in the examination. Don't try to attempt everything. Don't try to go in an unplanned manner. Be very planned. Hunt the easy questions down, the moderate questions down, and then we will see where we have landed. And based on that, we will take a stock of the situation. That is the kind of approach that you should have. Right. So I can see very different answers for the second question. Nilesh is saying that the answer should be E. Wandering is saying that the answer should be C. All right. And Swati Roy is saying that the answer should be B. So as expected in this difficult question, many students are going to attain negative marks for giving the wrong answers over here. Okay. So if you do not know the answer for sure, you can retract your comment. You can skip this question. Please give this flexibility to yourself. The answer over here is E. 1, 2, 3 and 4 is the answer over here. Now let me explain to you step by step how things are happening. What is the benefit of the GSAP program, right? So see, first thing that you need to keep in mind is that the situation in India because of the pandemic is such that government's expenditure has increased and government's revenue has gone down. This is point number 1. Please write it down, right? That government's expenditure has increased and government's revenues have gone down. As a result of which the fiscal deficit has expanded. When a country's fiscal deficit expands or when a government's fiscal deficit expands, it needs to borrow more for the market to be able to fill up that fiscal deficit. Very simple. So far I have not given you anything which is very difficult to understand. First thing is that yes, expenditure is increased, revenues have gone down. Second, fiscal deficit has increased. Third, to cover that fiscal deficit, we need to borrow from the market. Now, when the government needs to borrow from the market, so everybody knows that government needs to borrow a lot from the market. So government will be issuing bonds in the market to borrow, right? So the supply of bonds will increase in the market. The supply of bonds will increase because why? Government needs to borrow to fund its fiscal deficit. So when the supply of bonds is likely to increase in the market, right? The price of bonds, the price of existing bonds as well as the price of bonds, right? They go down because the supply of bonds is going to increase. Right? When the price of bond goes down, the yield of bond goes up. Please write this down, right? If you have understood that yes, fiscal deficit will increase, then the next thing that you need to write down is that when the supply of bonds is going to increase, right, the price of bond will go down. As simple as that. Because when supply increases, price is going down. Price of bond going down will cause the yield of bond to go up. It's a very simple inverse relationship that if price goes in one direction, yield will go in another direction. If price goes down, yield will go up. If price will go up, yield will go down, right? So what was happening was that on government bonds, yield was going up. When yield goes up, please write down, when yield goes up, what happens is that the cost of capital in the overall market increases. Yield is like returns. So if yield is going up, that means that government will have to pay a lot of money. Government is going to pay a lot of interest by way of the return on bond, right? So as a result of which, what was happening was that yields on government bonds was going up. When yields go up, that means the cost of capital has increased. When the cost of capital increases, it will become costlier for the government to borrow. Government will have to pay a lot of interest. It's as simple as that. Now RBI is watching this entire scenario, and to be able to bring this scenario under control, what did RBI do? RBI said that it will step up the purchase of government securities and it will bring the yield down, right? And it will cause the yield to fall. How is it that RBI is doing it? Please understand. When the RBI will start purchasing government securities, right? The moment RBI starts purchasing government securities, the price of those securities will start firming up, because the demand for those government securities has been created by the RBI. Since RBI is ready to spend 1.20 lakh crore rupees going ahead, so the signal has been sent to the market that the price of the bonds will go up, right? Because there is a new buyer in the market. The moment price starts going up, the yield starts coming down. And for the first time recently, for the first time after a very long time, government bond ka yields have fallen below 6%. Government bonds ka yields have fallen below 6%. Is this clear? If this is clear so far, please type yes in the comment section, because this is a very important interlinkage, this is a very important interconnection that I wanted to discuss with you. That how and why fiscal deficit went out of control, right? When fiscal deficit went out of control, it meant that government is going to borrow more. When the government is going to borrow more, the market knows that the supply of government bonds will increase. When the market knows that the supply of government bonds will increase, the price of government bonds decreases. When price of government bonds decreases, yields increases. When yields increase, the overall cost of capital increases. When cost of capital increases, everybody has to pay a higher rate of interest to borrow capital. RBI is watching this situation. RBI will emerge as a buyer in the market. When the RBI emerges as a buyer in the market, it will purchase securities. Because RBI is purchasing securities, prices of those securities will firm up and yields will come down. That means that yields will get moderated. If this is very clear to you, please type yes in the comment section. Please type yes in the comment section. Nilesh, Swati, Shobit, Wandering, Anshu. If you all have understood this entire interlinkage, please type yes in the comment section. Now, what has happened is that in April 2021, RBI purchased approximately 1 lakh crore ka securities in the April-June quarter. They announced in April 21 that we are going to buy 1 lakh crore ka securities. They have purchased securities, as the result of which the 10-year bond ka yield has declined by 15 basis point. So earlier it was 6.15%, the yield was 6.15%, and that has softened. And the governor himself is saying that there is a softening bias in government yield because of this program. And why that is happening is something that I have tried to explain to you. If you all have understood, please type yes in the comment section, right? Please stop focusing upon the notification of NABARD and try and focus upon what we are studying over here. The notification will come. You will be able to appear for the examination. What is the impact on markets and investors? Let us understand the impact on markets and investors. First of all, it has calmed the investors' nerves, right, by reducing the spread between repo rate and 10-year government bond yield. What is the meaning of spread? Let us say hypothetically that the repo rate is, let us say, 4%, okay, and the government ka 10-year bond ke upar yield is, let us say, 6.15%. So what is the spread? What is the difference between repo rate on the one hand and your government ka 10-year bond on the other hand? It is 2.15%. That is the spread between the government ka bond yield and the repo rate, right? This is anomalous. If the repo rate is 4%, so what is the RBI trying to say? That we are ready to lend at 4%. When repo rate is 4%, that means that RBI is ready to lend money to commercial banks at 4%, correct? If that is the case, then why should the yield on government bonds be as high as 6.15%? Why should it not be closer to 4% is the question. Because if the money is available from RBI to be borrowed at 4%, if 4% is the benchmark, then why is yield is 6.15%? So we want to reduce the spread. Every time RBI would try to keep the yield on government bond as close to repo rate as possible, because repo rate is the ongoing policy rate. It is the rate at which RBI is ready to lend infinite amount of money probably to banks, not infinite amount of money, a substantial amount of money. So if that is the case, we want to ensure that the bond yield is closer to the repo rate, and that is what we have done. We have pulled the government yield down from 6.15% to 5.96 or 5.97%. and jab hum 1,20,000 crores ki security we are going to buy more, we will further pull the yield down to closer to the repo rate. Is this clear? If this point number 1 is clear, then please type point number 1 is clear, yes. Second, what happens is that greater amount of money will flow into the equity market. Why? You are an investor, you are sitting on some amount of cash. You can either deploy that cash in gold, or you can deploy that cash in debt market, or you can deploy that cash in equity market. What is going to guide your decision? Your decision is going to be guided by the fact that where is the returns the highest? Where is it that I am going to get the highest amount of return on the money invested? So if you see gold attractive, you will invest in gold. If you see debt market attractive, you will invest in debt market. If you see equity market attractive, you will invest in equity market. Now, what was happening in the debt market? Everybody knew that government is facing a revenue crunch because of the pandemic, and there is a pressure on the government to spend more because of the pandemic. So the government will be forced to borrow more from the market, and when the government will be forced to borrow more, government can be forced to pay a higher rate of interest in the debt market, right? So many people thought that, okay, we will park our money in the debt market in government securities, which will pay a fancy yield, which will give a very good, beautiful return. Right? Why? Because it is government's need to borrow, so government will pay a higher rate of interest. We'll get a higher yield from the debt market. We'll get a higher return from the debt market. And government of India never defaults upon its securities. Right? So people were willing and wanting to invest in the debt market. The moment RBI started to pull the yield down, automatically that means that the returns that the investors will earn will be lesser. And therefore, those investors who were earlier probably willing to invest a lot of money into the debt market may probably invest a lot of money into the equity market. And it is not as if that I am trying to say this. It is experts who are saying this, that the moment yield declines in the debt market, equity markets becomes attractive and money will start flowing into the equity investments. Right? Are you getting my point? Third point, right? What happens is that when the yields on bonds is normally used as a risk-free rate when calculating the cost of capital. जो भी government के bond के ऊपर yield है, that is the cost of capital in the overall market. So when the yields go up, the cost of capital goes up. Because if the government is paying so much amount of return and is giving so much amount of return, right? So private borrowers should give a higher amount of return, right? Who is likely to default? Me, Vijay Mallya, or you, Government of India, right? So if Government of India is giving 6.15% yield, if Government of India ka bond is giving 6.15% ka yield, my bond should probably give a 12% ka yield. I am not making fun. All I am trying to say over here is that your private investors are likely to pay a higher rate of interest than the Government of India, because Government of India is never going to default and private guy can always default. So when yields are going up, when yields were going up, corporates will have to pay a higher interest because of the yields going up. There is a likelihood of bankruptcy because of high interest cost. There is a likelihood of default. There is a likelihood of panic. There is a likelihood of chaos, especially for your mid-sized companies. Nothing is going to happen to your Reliance Industries Limited, touch wood, hopefully. But your mid-sized companies, right, they can be wiped off if their interest costs are very, very high. Right? So we want to keep yields as low as possible so that we can reduce the borrowing costs, not only for the government, for the overall market. And if the borrowing cost is low, not only for the government, but for the overall market, people may be willing, or business persons and investors may be willing to borrow and invest and kickstart the investment. Because if you have to invest, you need to borrow, right? And you will borrow only when the cost of capital is reasonable. I will eat pizza only when the pizza is reasonable. If the pizza is very expensive, I will not eat pizza. Very simple logic. On very similar lines, if I am an investor, if I am a business person and I want to invest money so that I can start a profit making venture, so if that money is too costly, I will not invest. And if that money is reasonably priced, it is available at a cheap rate of interest, I will borrow and spend. I will borrow and invest. So these are some of the ideas. So I have tried to explain to you the logic behind the introduction of the GSAP program. And I have also tried to explain to you the impact of that launch of GSAP program upon the various sectors of the economy. Right? And based on that, I have given this question to you, and now I want you to attempt this question. that Reserve Bank of India's decision to step up purchase of government securities under the GSAP program can lead to which of the following outcomes? It can lead to a reduction in the spread between repo rate and 10-year government bond yields. It can result into greater inflow into the equity market. It can help reducing the borrowing costs for the government. It can keep interest rates steady, that can help to kickstart investments. What should be your answer now? If you have understood everything regarding question 2, which is one of the most difficult questions that I can create, please type yes in the comment section if you have understood everything and you can attempt this question now comfortably. Just give me the right answer over here, right? So Alok Pal, Swati Roy, Anshu, Debjit, Shushmita, as well as SS, as well as all those who are present and live with us, I want to see your answers to the second question, and I want everybody to give me the right answers over here. See, this is what we do at EduTap, right? It is our belief that the complex most topics can be simplified and be explained to you, and that is what we have done through our concept note, through our summary sheets, through our concept videos, through our everything that we have provided to you, right? And that is what we are trying to do over here in this session as well, right? So I hope that you are going to benefit from the same. The answer over here is E, and I am seeing many yeses over here, so I believe that students have understood. Moving ahead to the next question, right? Now another important paragraph was there in the governor's statement, right? It has been observed, governor was saying that it has been observed by the Reserve Bank of India that the prospects for capital flows to India are improving again. Prospects for capital flows is to India are improving again. So you should know theory to be able to understand that when we say capital flows to India, what is it that we are talking about? You should know the theory to be able to understand this. Which of the following can be an outcome of this development? What is the development that RBI is envisaging? RBI is envisaging a development where capital flows to India are going to increase. They are going to improve. What is going to be the outcome of that? Will it lead to tightening of external financing constraints? Will it impart volatility to financial markets and asset prices? Will it produce systemic fluctuations in liquidity? Right? You have to tell me what is going to be the outcome of increased or improved capital flows to India. That is the question that I am asking you over here, right? Chaliye, please give me the answer to the third question. I request all of you present and live to please write down the number, right? So write 3A, 3B, 3C, 3D or something like that, so that I can understand आप लोग का क्या answer है. So I can see that Anshu has given the answer as E, 1, 2 and 3. I am waiting for other students to please be kind enough to share your answers over here. Okay. Let us see some answers. Let us wait for some answers. Alright. So the answer over here should be your C. It should be 2 and 3. I'll explain the entire matter to you and then I'll give you an opportunity to attempt this question again. Okay. Let us see. First of all, the important thing that the governor is saying that the prospects for capital flows through, let us say, FII or FDI, that is improving. That means India is attracting a lot of dollars. Let us say that India is attracting a lot of dollars, right? Very recently, you may have heard the news that India's foreign exchange reserves has crossed $600 billion ka milestone. Never has this been done in the history of economic history of India, right? At least in the economic history of India after independence, right? So $600 billion our foreign exchange reserves has crossed that milestone. So when so much amount of foreign exchange reserve is there with the Reserve Bank of India, right? So those who are lending money, those external agencies which are lending money to Indian corporates or let us say government of India, they know that RBI is sitting on a cash pile of $600 billion, right? So if they lend money to Indian borrowers, their money is safe because RBI has a lot of firepower, right? So because of these inflow, external financial constraints will ease. It will become easier for us to borrow externally in terms of dollars because we will be able to pay interest. We will be able to repay the amount that we have borrowed because we are sitting on a cash pile of $600 billion worth of foreign exchange reserves, right? That is point number one. Point number two is that whenever foreign exchange reserve is coming into India via the FII route, it is coming into the share market, it is coming into the debt market, it leads to a lot of volatility. right? Suddenly when you see that, okay, 20,000 crore has flowed into the markets in 1 month, that means that there is a lot of pressure upon the exchange rate to appreciate. Suddenly when that 20,000 crore rupees will go out of the market, and it will go out of the market one day or the other, there will be a lot of pressure of depreciation on the exchange rate. Suddenly when the money is coming in, we have seen recently that India's growth rate in the last financial year is approximately minus 7.3%. But in the last financial year, BSE Sensex as well as Nifty 50 has broken absolutely every record that was there to break, and share prices are at all-time high. How is this happening? What is fueling this bubble? Because even the RBI is saying that the share market is overpriced. What is happening? So there is an asset price ke andar a bubble has been created, and when so much dollar comes into the country, you know that when dollar is coming into the country, it will get converted into rupee, and that rupee will get released into the market. So if let us say $1 comes in, that will cause 73 or 74 rupees to get released into the market. So what will happen is that when billions and billions of dollars come into the Indian market, accordingly liquidity gets injected into the market, right? Now how does RBI make sure that its monetary policy is successful? By managing liquidity. So if RBI wants to control inflation, it will manage liquidity. If it wants to boost growth, it will manage liquidity. Now when then these thousands and thousands of billions of tens of billions of dollars are coming into the Indian market, right? So it sort of it messes up RBI's liquidity calculation, and RBI has to mop up excess liquidity when the inflow is happening, and then RBI has to also manage their exit. So what RBI has to do is that it has to undertake a two-sided intervention to stabilize the financial market. When inflow is happening, it needs to absorb that. When the outflow is happening, it needs to smoothen that, so that our national objectives can be pursued. And how is that done? By purchasing and selling foreign exchange. So when the inflow is happening, we have to purchase foreign exchange. When the outflow is happening, we have to sell the foreign exchange. And RBI has done that well, as a result of which the governor is able to confidently say that the overall market is stable and the overall market is behaving in an orderly manner. If this much is clear to you, if you have understood, this entire discussion is based on that paragraph in the governor's statement. And this is very clearly linked to your theory. If you have gone through our balance of payment ka chapter, you will be able to understand the concepts of appreciation, depreciation. You will be able to understand the concept of external commercial borrowing. You will be able to understand that how RBI takes steps to manage exchange rate, right? Based on that understanding, you will see this question over here, and I want all of you to attempt this question again. That it has been observed by the RBI that the prospects for capital flows to India are improving again. Which of the following can be the outcome of this development? Will it lead to tightening of external financing constraints? Will it impart volatility to financial markets and asset prices? Will it produce systemic fluctuations in liquidity? What is the meaning of the term systemic? System-wide. Entire financial market will be flooded with liquidity, or will see an withdrawal of liquidity at some stage. So you have to tell me what is the right answer to the third question over here, right? Please tell me the answers over here. I am requesting all of you. So wondering, your comment is correct. RBI recently bought a lot of foreign exchange for the simple reason that so much foreign exchange is flowing into the country, and we cannot allow the rupee to appreciate too much. We cannot allow too much liquidity to get injected into the market. That is why RBI is purchasing this foreign exchange reserve, because tomorrow when this foreign exchange reserve is going to go out of the country, that outflow is also going to be very vigorous, and that needs to be smoothened out. That is why RBI is purchasing so much foreign exchange over here, right? I am requesting all students participating in this answer to please share your answers. I am not seeing answers being shared over here. The answer to this question is C. आप लोग को समझ में आ गया है? Are you all understanding? If you are understanding, please type yes in the comment section. I am very curious to know whether you have understood or not. Moving ahead to the fourth question. Recently a scheme was started. Simple question. This is a simple question, don't worry. On tap liquidity window for contact intensive sectors. This scheme was started by RBI, and we are going to provide targeted liquidity to stressed sectors. What is the meaning of targeted liquidity? This is a beautiful concept that I came across in the governor's statement. Generally, by reducing the repo rate, by reducing the CRR, by reducing the SLR, we release liquidity in the entire system. Anybody can borrow and do what they want. In the recent past, RBI has been injecting targeted liquidity towards certain sectors. Okay, what is the meaning of targeted liquidity? Specifically focusing liquidity upon certain sectors such as contact intensive sectors. के लिए special window has been created so that they can borrow, so that banks can borrow and lend to these sectors. You have to tell me which of the following sector is not covered under this scheme. car repair services, private bus operators, event conference organizers, tertiary hospitals, adventure heritage facilities. Which of these is not covered under this scheme? Whenever you are reading any scheme, you should for sure know who are the eligible beneficiaries, for sure know who are not the eligible beneficiaries. This is one of those questions where I'm testing your knowledge, whether you do you know who are the beneficiaries and who are not the beneficiaries. This is what I'm testing, and as I expected, I'm seeing very clear and right answers over here. The answer over here is D. Tertiary hospitals have not been made a part of this scheme. So what we want to do is that we want to mitigate the adverse impact of second wave upon contact intensive sectors, right? Contact intensive sector, I have not, cut my hair, so I have a ponytail, right? Despite being bald, I have a ponytail behind me, which you cannot see over here, right? You can see the shape of my beard, pretty fancy. So why? Because I am really scared to go to the salon, right? It's just as simple as that. So what I am scared of, many people are scared of. So contact intensive sectors are facing a demand crunch. They are facing very tough times. So RBI has created a special liquidity window of 15,000 crores, whereby up till March 31, 2022, banks can borrow and lend for 3 years, right, to these contact intensive sectors. So banks can provide fresh lending support to hotels, restaurants, tourism, blah 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 blah. But the important thing to note over here is that there is no mention of any tertiary hospital. They can lend to beauty parlors and salons. They can lend to event conference organizers. They can rent to spa clinics, rent a car service providers, car repair services. They can lend to all kinds of characters, but they cannot lend to tertiary hospitals under this scheme, right? And under this scheme, whatever money is lent, right, you can park equivalent amount of that money under the repo rate, reverse repo rate mechanism at a higher reverse repo rate. So if the reverse repo rate is, let us say 3.35% and the repo rate is, let us say 4%, okay, let us say I am HDFC Bank, and under this scheme I have lent 500 crore rupees to Lakme Salons. I have lent 500 crore rupees by borrowing from RBI under this scheme to Lakme Saloon. Okay. So tomorrow, if I want to park 500 crore rupees under reverse repo ka mechanism, so when I will park that 500 crore rupees, so I'll get how much interest rate by reverse repo mechanism? I'll not get 3.35%. I will rather get 3.75%. So I'll get a higher reverse repo rate. Why? Because I have lent to a contact intensive sector under this scheme. So whatever amount that I lend, equivalent amount I can park under reverse repo rate mechanism at a higher rate of interest. That is why the answer to this question is D, and this is the entire explanation. I hope this is clear to you. Moving to the next question, right? The Resolution Framework 2.0 announced by the Reserve Bank of India on May 5 provides for resolution of COVID related stress of which. Now this is a blooper on my part, right? There was some problem in the animation. So there is a scheme. The scheme is called Resolution Framework 2.0, right, which was announced by Reserve Bank on May 5th, 2021. And through this framework, COVID related stress being faced by MSMEs, non-MSME small borrowers and individuals who have borrowed for business purposes, their stress is being relieved. राइट सो एक्सपोर्ट ओरिएंटेड यूनिट्स को इस स्कीम के अंदर नहीं कवर करा गया है. वी हैव कवर्ड ओनली 1, 2 and 3. Right, that is why the answer to this question is your A. Please understand this scheme that this was announced on May 5, 2021 to relieve stress of 3 characters: MSMEs, non-MSME small businesses and individual borrowers for business purposes. Now what we have done is that we want to make sure that a larger set of borrowers are getting relief. Okay, so what we have done is that we have said that all those who have borrowed up to 50 crore rupees can be covered under this scheme. Earlier we had said that those who had borrowed up to 25 crores can be covered under this scheme. Now we are saying that those who have borrowed up to 50 crores can be covered under the scheme. Is this clear? Are you comfortable with Resolution Framework 2.0? You should know who has launched it. RBI has launched it. When has it launched? May 5th, 2021. Right? Who all will be covered? Up to 50 crores characters will be covered. Who specifically will be covered? MSME, non-MSME small businesses as well as loans to individual business purposes. This much amount of information should be very clearly known to you so that you are in a position to attempt this kind of a question in the examination. If you are understanding, please type yes. If you are learning something new, please like and share this session. Moving to the next question. Again, there is an issue on my part over here, right? So the question that I had created for you, and I'm very sorry that this is happening. The question that I had created for you was that I had given you a statement. Okay, now let me explain to you how we think. Let me explain to you how I created this question. I came across this item in the governor's statement that we have created, flexibility has been given to liquidity management by issuers of certificate of deposits. What the RBI has done is that they have made it easier for regional rural banks to be able to manage their liquidity. And how is it that Reserve Bank of India has helped the regional rural banks in managing their liquidity? Now RRBs have been permitted to access liquidity through the windows of RBI, right? Through the liquidity windows of RBI, right? Which is the LAF, that is liquidity adjustment facility. RRBs have also been allowed to access the call and notice money market, right? Apart from that, it has also been decided that RRBs will be permitted to issue certificate of deposit. Okay. Now the moment I read this, that RRBs will be permitted to issue certificate of deposit, my mind asks me the question that what is certificate of deposit? So it is a negotiable money market instrument, right, which is issued in a dematerialized form electronically, right, or as an usance promissory note against funds deposited at a bank or other eligible financial institution for a specified time period. This is a simple definition of certificate of deposit. You will come across such things when we talk about finance, when we talk about all these things. Okay. Now, when we see this definition, so based on this definition, we should be able to identify that this definition is not talking about commercial paper, it is not talking about NCD, it is not talking about notice money, but it is talking about certificate of deposit. And why did I ask this question of certificate of deposit? Because RRBs have been given the permission to issue certificate of deposit. Another question that could have been framed based upon reading this news article would have been on regional rural banks. Then in which year did RRBs were set up for the first time? Which committee recommended the establishment of RRBs? Why are we consolidating RRBs? Which committee recommended the consolidation of RRBs? Right? So these questions can also be asked to you. So what I'm trying to demonstrate over here is that when you read this kind of a news article, at least two kinds of questions should come to your mind. What are RRBs? What is certificate of deposit? That is the minimum that you should ask yourself, right? Moving ahead to the next question. Okay. Again, the next question is regarding your, now I'm rather than, showing the answer to you, I want you to read this question and give me the answer. Okay. Please read the question. That it is a bulk payment system which is operated by NPCI, right? And it facilitates one-to-many credit transfer. Through this system, we are able to ensure one-to-many credit transfer. So government of India is there on one hand, and if it wants to transfer money to lakhs of beneficiaries, so that can be done through this system. So if dividend has to be paid or interest has to be paid or salary pension has to be paid, it can be paid through this system which is operated by NPCI. If payment has to be collected for electricity, for gas, telephone, water, etc., it can be done through this system which is operated by NPCI. Which payment system are we talking about? Can you recognize the payment system that we are referring to in this particular passage is the question. Please type the right answer over here if you are understanding. As expected, Anshu and Nilesh have written that the answer over here is NAC. I'm very happy, right? And National Automated Clearing House is the answer over here. Brilliant performance, my friends, brilliant performance. I'm very happy that you know this answer. The answer over here is in fact NAC. I had created these options for you: CTS, NAC, NFS, AEPS, none of the above. And I'm very happy that Debjit Pal, Anshu and Nilesh have been able to give the answer without looking at the option. That is something that I find absolutely brilliant, absolutely praiseworthy. Right? So this is the news item that inspired this question. RBI is proposing that they want to make NAC available on all days of the week effective from August 1, 2021, right? So earlier what was happening was that NAC was available only on certain bank working days, right? But now RTGS is available 24/7. Since RTGS is available 24/7, so RBI is contemplating, it is proposing that we want to make NAC available 24/7 all days of the week from August 1, 2021. This is a major decision that is being taken, my friends. This is a major decision, which is why I believed that you should have some idea about NAC, which is why we created the question that we created. Moving ahead to the next question. Now again, this is a question which you will answer without looking at the options. Okay, so please read the question. To further support the funding requirements of micro, small and medium enterprises, right, particularly smaller MSMEs and other businesses, right? And those who are facing a credit deficiency, those who are operating in aspirational districts, right? It has been decided by the RBI that they will extend a special liquidity facility to SEBI so that on lending and refinancing can be done favoring these smaller MSMEs. What is the question? A special liquidity facility has been created by the Reserve Bank of India for SEBI to use. SEBI is supposed to lend that money, right, to cater to the funding requirement of MSMEs, particularly smaller MSMEs, right, who are facing a credit deficiency and who are operating in aspirational district. What is the size of this facility that has been created is the question that I wanted to ask you. Please be kind enough to share your answers without looking at the options over here, right? So the answer that I am getting from certain students, Siddhant Upadhyay has said that the answer is 16,000 crores. Anshu and Nilesh have also said that the answer is 16,000 crores. And answer is indeed correct. Answer is in fact 16,000 crores. So these were supposed to be my options. And I am pleased to note that you are attempting these questions without options. And I am apologetic that my animations have gone wrong today and the answers are visible before the option is visible, right? But I'm happy to note that you all are able to answer without looking at the option. That is good. That is very good, right? So yes, you have already understood that earlier a 15,000 crore ka facility was created for SEBI. Now another 16,000 crore ka facility has been created for SEBI, right? So please note down all these numbers. 50,000 crore was provided to all India financial institutions for new lending in 21-22. So you should know that number 50,000 crore. Out of that 50,000 crore, 15,000 was earmarked for SEBI. Now, apart from that 15,000 crore, 16,000 crore has been made available for SEBI for on lending and refinancing options. I hope that this is very clear to you. Moving ahead, these are your homework questions. As I promised to you, I will give you 5 homework questions, right? And these homework questions are again based on the governor's statement. If you have gone through this lecture, the entire governor's statement, or you can say 80% of the entire governor's statement has been covered via questions. All important things that were available in the governor's statement, which could form a basis for the question, have been covered via this lecture. I want you to answer these 5 questions right at the end of this session and immediately comment it. Do not waste any time. The moment you have seen this session, find out the answers to these 5 questions and comment it immediately. I request all of you to do that, right? I want you to share your scores with me. I want to apologize again for my animations not behaving properly, right? Visit www.edutap.co.in. You can write to us on hello@edutap.co.in. You can call us on 8146207241. You're preparing for NABARD examination, RBI examination, SEBI examination, IB examination, EPFO examinations going ahead. You can visit our website and enroll in our courses, which are very beautifully tailored to meet your requirements for these exams, right? So I request you to please share your scores, right? Bikiran, you are asking, is it lecture 3 or lecture 4? So it is actually lecture 3 because this is lecture 3 because my previous lecture got cancelled for unavoidable reasons, right? So this is actually lecture 3. So we'll change the thumbnail and the title. Don't worry, this is lecture 3 and the next one is going to be lecture 4, right? I'm sorry about this as well, right? So I request all of you to please share your scores. I want to see what your scores are. If you have liked this session, if you have learned something from this, please do like and share this session. That will be very great for us, right? So please do share your scores. I request you to please share your scores over here. All right, before saying thank you, please share your scores. Right. Okay, scores are not coming. Fair enough. I hope that you have enjoyed and learned something from this session. Thank you very much. All the very best and Jai Hind.